Hey, welcome to The Explainer. As an investor, one of the holy grails is finding an income stream that doesn't just pay you, it gives you a raise, year after year. Today, we're digging into some source material that shines a light on three French giants who have pretty much mastered this exact art, the art of the ever-increasing dividend. It's really the golden question, isn't it? How do you actually find those companies that don't just send you a check, but make that check bigger and bigger over time? And look, it's not always about finding the highest starting payout right out of the gate. The real magic, the thing we're chasing, is the power of consistent growth. And that's exactly what we're digging into today. The source material we're looking at points us to three specific companies from the French market that have become famous for this very quality. These are businesses that have made rewarding their shareholders with a growing dividend a core part of their whole identity. All right, let's get into it.
First up, a name you'll definitely recognize, L'Oreal. I mean, in the world of cosmetics and consumer goods, they are an absolute empire. But as we're about to see, their real beauty, at least for us as investors, is in their track record of consistent financial growth.
Okay, so you see a 1.5% yield, and you might think, that's it? And yeah, on its own, it's not exactly going to make headlines, but the source is super clear on this. For a company like L'Oreal, that starting number is just the beginning of the story. The real magic is in the growth.
So what's the engine behind that growth? Well, it turns out L'Oreal has what the source calls a solid tradition of raising its dividend. And this isn't just a fluke, right? It's a deliberate policy, and it's built on this rock-solid foundation of regular profit growth. Their massive brand power gives them this incredible strategic moat, which lets them generate consistent sales and profits. It's pretty simple, really. As the company earns more, it shares more. Okay, let's move on to our second champion and see how this theme builds. This time, we're stepping into the world of high-end luxury with LVMH. This company is just a dominant force in its market, and its approach to dividends is every bit as premium as its products. And look at that. We're seeing a similar story here. A modest starting yield, kind of like what we saw with L'Oreal. But you know the drill by now, right? That number is hiding a really powerful trend. LVMH has this incredible history of increasing its payout almost every single year, which can turn a small initial income stream into a much, much larger one over time. So how do they do it? What's their secret? Well, it's really a killer combination of a few things. Their dominant market position gives them incredible pricing power, and the luxury sector itself has proven to be surprisingly resilient. When you combine that with a strong operating margin, which just means they're really good at turning sales into profit, you've got a cash flow machine that can fuel those consistent dividend hikes. All right, for our third and final company, we're switching gears completely and heading into pharmaceuticals. Let's talk about Sanofi. Investors love this company, not just for its products, but for its incredibly stable and, you might say, healthy dividend policy. Now, this is where it gets really interesting. Look at that yield, around 3.5 to 4%. That's a whole different ballgame compared to L'Oreal and LVMH. This really shows how different sectors can offer totally different profiles. In this case, you're getting a higher starting income plus that history of growth. Yeah, the key word here, the big idea with Sanofi is stability. As the source points out, the pharmaceutical sector is just way less volatile than a lot of others. I mean, think about it. People need their medicine whether the economy is booming or busting. That creates this deep strategic moat, which leads to regular and predictable cash flows for the company. And that predictability is exactly what lets Sanofi maintain that consistent, growing dividend. Okay, so let's recap. We've got cosmetics, luxury, and pharma. Three totally different businesses, right? But they all have this dividend champion title. So what's the secret sauce here? What's the common link that ties them all together? Well, this source material boils it all down to a pretty elegant two-part formula. On the one hand, you have the culture. That's the commitment from the very top to reward shareholders with an increasing payout. But just wanting to do it isn't enough. You also need the engine, that stable, powerful cash flow that actually funds those promises. It's the combination of the will and the way. Okay, this brings us to probably the most important part of this whole explainer. How can you take these ideas and use them in your own research? Well, the source gives us a simple but really powerful checklist to help you spot these potential dividend champions for yourself. It really just boils down to asking two simple but super powerful questions. First, is the dividend sustainable right now? Can the company actually afford what it's paying out today? And second, what about tomorrow?
Is there a clear path for the kind of profit growth they'll need to fund future raises? And to answer that first question, is it sustainable? There's a key term you've got to know: the payout ratio. All it is the percentage of a company's profits that it's paying out as dividends. The source offers a great rule of thumb here. You want to look for companies with a ratio below 60 or 70%. That just means there's a healthy cushion left over and room for future growth.
And that really leaves us with one final big question. We've looked at 3 champions from France that have mastered this art of the growing dividend. They do it by combining that shareholder-friendly culture with a strong financial engine. So the question for you is, using this checklist, who are the champions and the contenders in the markets you follow? Thanks for sticking with me on this explainer.